Hey everyone, Upstart reported fourth quarter and fiscal year 2023 earnings results that sent the stock price crashing. Of course, I had told investors not to buy Upstart stock coming into this quarterly update. I thought the company's prospects were in poor shape with revenue going backwards and profit going negative. So in this video, I'm going to review Upstart's latest earnings results and update my recommendation for Upstart stock. I'm going to answer if this dip is now a buying opportunity or if Upstart stock is still not a buy. So let's get into the results and let me upgrade my recommendation for Upstart stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Upstart said that total revenue was 140 million, which was a decrease of 4% from the same quarter the prior year. Now, that was an improvement because overall for the year, revenue growth was much worse, and we'll get to that in just a little bit. So they made 129,664 loans that were originated, which totaled 1.3 billion across the platform in Q4. That was down 19% from the same quarter prior year. So they're making less loans on the platform. They're originating less loans on the platform. The conversion rates were higher from the same quarter prior year, 11.6% compared to 10.5% in the same quarter the prior year. So conversion on the number of applicants. People certainly want loans, right? There's rarely a shortage of people that want to borrow. There's an abundance of people that want to borrow. It's finding that right borrower for lenders to make those loans, right? You don't want to just give your money to anyone. You want to lend to qualified borrowers. And that's where Upstart aims to make a big change in the industry. They're using, of course, artificial intelligence to make these lending decisions, and they argue that they can provide better lending decisions than the traditional lending model, which uses FICO scores and all of this other traditional methods to make that decision when to lend and how much to charge for each borrower depending on their credit rating, their credit scores, and all of that information. So far, it's too early to tell if Upstart's different model for lending is better. It's too early. We don't have enough data. We need a few economic cycles, or at least one economic cycle. Upstart has not been through a prolonged recession where there's an abundance of job losses, and then we can determine how the loans that Upstart originated, how they performed, and compare them with traditional bank loans and traditional lending methods and evaluate whether or not their model is indeed better. If we had that data and we could prove that Upstart is indeed better, then lenders would flock to Upstart's platform because they would be convinced that it's better. But right now, they're not. Right now, you saw lending is down on the platform, while overall, lending is not really down, right? Consumers are still borrowing. The borrowing economy, loan originations overall more broadly are increasing. So Upstart is losing market share. Now, this is a short-term factor. This is the cyclicality of the business coming into play here. If Upstart proves the business model, that's going to create a surge in lenders coming to the platform. But also, if it doesn't, if it proves that it's less valuable, if it proves that it's less informative, if it proves that its lending model is not as good as the traditional lending models, then that could create a further crash in the stock price. So on top of the decreasing revenue and decreasing profitability that we're seeing, there's also heightened risk with Upstart stock. So I hope that explains a little bit what's going on and why the stock price is so volatile. So GAAP net income was negative 42.4 million in the most recent quarter. That was better than the 55 million loss in the fourth quarter of the prior year. I will highlight though, if you rewind a little bit, when Upstart's revenue was much higher, the company delivered profitability. It showed to investors that at a larger scale, it's a profitable business model. So it did prove that to investors, and that's partly why the stock price was, almost 10 times higher than where it is today. Because when it was 10 times higher, the business was growing rapidly and it was delivering profitability on the bottom line. That's a much bit different business than where it is today, where it's decreasing revenue and it's losing money on the bottom line. Those aren't attractive characteristics. So when or if it returns to that level, it could deliver explosive returns, but it's also, remember, it could retreat big times from here as well. For the 2023 fiscal year, total revenue was $514 million. That was down 39% from the prior year. So I mentioned that things got better, right? Because in the fourth quarter, revenue was only down 4% from the prior year. For the full year, revenue was down 39%. So things got better as the year progressed. They made 437,000 loans for the year, which was down 59% for the year. In the most recent quarter, it was only down 19%. So it was a tough year for Upstart, but it got better as the year progressed. Net income, or the net loss, we should say, worsened to $240 million for the year. That was worse than the $109 million from the prior year. So they lost almost 2.5 times more money in 2023 than they did in 2022. 2 straight years of over 100 million in loss on the bottom line, and it's just going worse, right? It's going backwards. That's not somewhere that investors are looking to jump into, right? Even though Upstart is a artificial intelligence stocks and AI stocks have been on fire, Upstart has had difficulty capitalizing on that trend because the fundamental characteristics of the business, lending, right? It's a lending business, is not going well for Upstart. For the first quarter of 2024, the company expects revenue of 125 million, which would be down from the Q4 of 140 million. So again, going backwards, and then a net loss of 75 million is expected, which if you annualize that would lead to about 300 million in net loss for the year. Although this business does not really, the losses in the first quarter may not be representative of the losses in the second, third, and fourth quarter. I'm just annualizing it just to give you a perspective here. But the net loss of 75 million expected in Q1 would be much worse than the net loss of 42 million the company delivered in the fourth quarter of 2023. So not going in the right direction. So things were improving to end 2023, but it looks like management doesn't expect those improvements to continue for the first quarter. And in combination of those poor prospects and the poor outlook caused the stock price to fall. After the company announced these earnings, you can see the stock price falling from around $32 per share. It's now trading at about $27 per share. And on a forward price to sales basis, it's at 3.056. It's less expensive than it used to be, but I still don't think this stock is cheap, considering its characteristics of declining revenue, worsening profitability, and a yet to be proven fundamental business model. So all that being said, I'm still not recommending Upstart stock as a buy. I'm saying you should, if you already own it, maybe hold it. If you don't own it, then I would wait for a better opportunity to get in. And it's going to take a lot to upgrade Upstart stock to a buy. One of the things I'll be looking for is an improvement on profitability on the bottom line, an improvement in lending, an improvement in the interest from lenders to join the platform as a result of something being proven from its data, from its lending portfolio, showing that it is indeed better than traditional lending models and how much better it is. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.